Hey, thanks very much. Welcome back. Chuck Malamut is here, and the following program that you're about to listen to melodiously is presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of today's broadcast. They're subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley, Smith Barney, member SIPC. Now, Chuck, let me just bring up something that it's not part of today's format. It's not part of today's agenda because I know you have a lot of ground that you want to cover, but I have maintained for a long time that China's currency would become a world benchmark, and I am here to claim my truth becoming self-evident prize because it's going to happen, Chuck. It's going to happen.
Good morning, Harry. Congratulations. Sounds like you picked one winner.
There you go.
So, good job.
Wait, are you confusing me for Mike Torpy?
No, why would I do that, Harry?
Because he's great at his day job, but please don't take his advice on recreational only, entertainment only football picks. Please. But I love Mike Torpy. But don't go with his football picks.
Harry,
go the other way.
Thank you. Off the show. I'm sure Mike's listening, but
I think Bill's about 20 games ahead of Mike Torpy. Bill Malamut. Bill Malamut, he is threatening to win the whole thing, Chuck.
Well, Harry, as Bill starts to break away from the pack, but he's at the top, but his text messages to you come earlier and earlier on Tuesday mornings. I noticed that.
Usually it's when we start.
Now it's in advance. But he might.
Now it's
I
at
guess
the 7 o'clock hour.
He probably has something going on. That's why he wanted to just make sure you understood everything in advance.
For the week, Bill Malamut 11-5. This is, ladies and gentlemen, this is with point spreads. It's not just picking winners. That's easy. This is with point spreads. It gets very, very tricky. And some of these point spreads were wide, and you didn't know which one to take because would a team be able to win by that much? Did many people think New England was going to lose to this this Gostetler or whatever the guy's name is, Osterheiser, from Denver? I mean, they beat them, and that surprised me. I think if Peyton Manning had been playing well, I would have gone with Denver in that game, and they would have been getting a few points. This Ostetler, or whatever his name is, this guy beat the previously undefeated New England Patriots. That's the kind of, prognostication that you have to do in this entertainment pool that we do for recreational purposes only. But with considering all of that and all these spreads, Bill Malamut 11-5, Harry Hurley in the morning 10-6, brother Chuck Malamut a close 9-7.
Yeah, Harry, it was certainly an interesting weekend for the listeners that weren't watching last night. I definitely would. I didn't see what Mike Torpy did this week, though. No, we won't go there.
All right. I'm a big fan of Mike's.
It'll be a long day for me, Harry, and I really don't need you to get my day off on the wrong foot with Mike.
I'm a big fan of Mike Torpy.
So anyway, the good news is it seems just so long ago that we were in the midst of the summertime, and typically you get that summertime blues and it gets very, very quiet. And as you know, this year, that awful day that we had August the 24th where the Dow, was down over 1,000 points at the beginning of the day, a lot of the volatility is now out of the market. Yesterday, last week, and we're trading in a pretty tight range right now. And Harry, I think that's what we need at this point in time. We need to be able to convince investors that equities should be an important part of their liquid assets, and get the retail investor back on board.
So by way of market update, anything else you're going to share before we get to third quarter earnings, your final tally?
Well, Harry, last week, if you look at the indices, the S&P was up, fractionally, it was up 1/10%. The Euro stocks, the 50 largest market capitalization in Europe, they were up 0.6. So if we're looking now year to date, S&P up about 3.5%. The biggest winner, globally speaking, is the Nikkei, the Japanese market, up almost about 13%. The biggest loser is the MSCI, or the emerging markets, down about 11.5%. So you can see that the divergence, so to speak, between your higher quality equities versus your more aggressive, that being the MSCI E for emerging markets per se. So I think what is happening here, Harry, we're getting towards year end. I would expect, a little bit of volatility as we get prepared for tax loss selling. It sounds like I'm a broken record, but we're right in the midst of it, and it's, I think if your listeners aren't paying attention, they're going to be very, very disappointed next April when they get their tax bill and they found out that they had a pretty large capital gain distribution, didn't do anything to work their way out of that or reduce it, and now they have a pretty big tax bill to pay. So there is time still, but it's like anything else, Harry. It's part of the planning process. You can't drive to California without a roadmap or GPS. It just can't happen.
So the end of the year is near. We're in the final month. You've given some very, very, I think, important advice about making the appropriate decisions before year's end so that you're not hit with something that could be more, better handled. So that's good. And you'll do what you always do in the run-up to the end of the year. You do a great job in helping people in some of those areas. But as we now know it, we're very, very soon, if not already, in the holiday mode. So the year's pretty much over, isn't it, Chuck?
Harry, I think we're fairly close. I mean, it's we've gotten through third quarter earnings. Obviously, it's something we're going to want to chat about in a second. But the next big event is the Fed meeting, and all eyes on the Fed. And there's, I guess, if I were a betting man, we're seeing there's probably about a 70 to 80% probability they're going to make a move. And I think, there's conflicting reports out there with respect to the Fed and, why they make, do they make the move and why do they, in fact, make the move. So I think if you kind of take a look at third quarter, 95% of the earnings are in. And it's pretty clear that the earnings that we have seen that have passed, the most of those are not strong enough to push equities substantially higher at this point in time. And that's why you're going to have that continual back and fill process within the equity markets. Earnings for the quarter, Harry, were down 3.3% year over year. Revenue growth contracted by about 4.4%. Now remember, part of that is, the issues that we've had in the oil patch with the decline in the price of the pump and price of fuel and price of oil, so to speak. But so we've had year after year of moving these profit levels higher and higher. So, margins are coming under a fair amount of pressure, profit margins at this point in time. So, I think that's why you're seeing the market at this point in time just, sort of at a standstill. You're not, I don't see anything coming other than the Fed meeting over the next couple of weeks that's going to push the market, in one direction or another.
That's what I think. That's why I think where we are is where we are. A quick public service announcement. I want to thank guest listener Tim, who was in the midst of it. There was an accident just a little while ago, northbound Garden State Parkway at mile marker 17.7. That's a Sea Isle rest stop area. There's a 10 to 15 minute delay as of just a little while ago. So if you have a way to avoid this, be guided accordingly, and maybe you can get off the express or the parkway, and who knows, get on Route 9 for a little while, pop back on, but you're going to get in the midst of something that's quite a delay to start your day if you're not able to make an adjustment. Chuck, I want to share an item with you that's not a surprise to me. You and I have been covering this topic for many, many years together. Black Friday spending. I'm going to say bricks and clicks. Bricks are the bricks and sticks, bricks and mortar stores. Clicks are internet. So bricks sales down over 10%. Clicks up by more than 14%. So this long-standing trend of fewer and fewer people actually purchasing in a physical store continues with a double-digit 10%, little over 10% decline. people buying on the internet up over 14%. Your thoughts?
Harry, I think it's a trend that's going to continue, and
there's great deals on this internet stuff and free shipping for the most part, Chuck. Why not?
I will tell you that my wife was, I believe, in Target yesterday, and she said it was nothing short of a disaster.
Was it mob?
It was very, very crowded, and it was that you put your order in online, and then you would come to the store to pick up. And I'm not sure in the midst of where she was, but she said it was not a pretty scene.
No.
With boxes that are broken and goods within the boxes that were broken. So I heard this. I wasn't there, so I still think we have a fair amount of work to do. But bottom line,
I'll give you an idea. I ordered some stocking stuffers for each of the kids, and then their significant others. And they're going to love it, by the way. If anybody's listening, you're going to love your one stocking stuffer item that I'm referring to. It's a really nice item. I didn't have to go anywhere. I went to my H phone. I went to Amazon.com. Free shipping, Prime membership. It's going to be here tomorrow. I didn't do anything.
Yeah, so you've seen, obviously, a shift. And the question is, at the end of the day, holiday spending was projected to be up about 2.5%, I think, to 3.5%. That was the initial read. I
think if bricks and sticks stay down by 10%, and if the internet spending goes up by 15%, the 15% is a bigger number, so it's even bigger than it sounds. It'll probably be in that realm, 3 to 5%.
The initial reports that came out was a little disappointing with the bricks and mortar, but I think that what has happened is that the holiday, the Black Friday, as we know it, has shifted significantly, to Thanksgiving Day.
And some big stores didn't even open on Black Friday. So I had a list of them. Yeah. I don't have it here now, but a lot of them didn't even open on Black Friday.
So you're starting. So I think they're going to have to rework the way this is reported, and obviously, Thanksgiving be part of the holiday number, so to speak, but. I think bottom line at the end of the day, if the projections are correct with 2.5, 3 to 3.5% of growth year over year, that's obviously good for the economy. And I heard you earlier this morning on one of your, I don't want to call it one of your rants because that's really not fair. But
thank you. One of my very well researched. Passion.
Yeah, I was going to say passion. There you go. I think that's the best word. So we could also refer to it as a rant, but that's okay.
We will not.
But the bottom line is, in spite of GDP, just at that 2 to 3% range, the Fed has finally found their way to go ahead and make that move. Now,
and by the way, I don't blame them for having a tough time of it because we had 4 years during the Great Depression where we grew beyond 3%. We haven't even been able to grow beyond 2% during a Great Recession that literally, by the book, we came out of how many years ago, Chuck? I forget.
2010.
Okay. So, and still we haven't grown by more than we grew during the Great Depression years. Nobody wants to talk about that because it's very inconvenient truth. But to say the Fed found their way to finally be able to raise interest rates after 10 years, Chuck, that's very complimentary on your part.
Well, I think investors look at this a couple ways. From a negative perspective, investors could view this first rate hike in not a great way, believing that the Fed, is maybe acting prematurely. And putting the economy, which is, I guess, the word fragile is probably a good way to describe our economy. Yeah, but
should something be fragile after 7 years, 10 years?
Well, now on the flip side, investors could view this movement of rates to be somewhat positive because they're finally going to be able to breathe somewhat of a sigh of relief that
the economy is healthy enough to be able to do it.
Well, the economy, Harry, is healthy in certain parts of the economy. And then there are other parts of the economy that we just continue, to suffer. So
you know what's stunning, and Hurley in the Morning special guest host Kirk Conover, Wharton School graduate extraordinaire, sent me an item. The Great Recession ended June of 2009, which means all of 2010, 11, 12, 13, 14, and now all of 2015, 6 full years. Has there ever, Chuck, be real here now, and you always are, has there ever been anything like this? 6 years after a recession ended to have this kind of anemic growth?
We look, it seems, historically speaking, no. It seems we're sort of in I guess the best way to describe it, sort of like in a time warp where... Or
the new normal.
Well, the new normal...
Which I hate.
The new normal, I don't think is terribly acceptable.
It's an excuse.
With the technology enhancements that we've had,
I'll never forget.
Globally,
it was 1992, ladies and gentlemen, and 4.6% GDP was considered the worst economy in 50 years, and now 2% is the new normal. You can't even make this stuff up. Ladies and gentlemen, our first time out, Chuck's got a whole lot more. He's going to cover GDP revision. The Fed, we talked about it a little bit. Global economy, we'll get to. And we'll do all that in just a couple of minutes. You're listening to Chuck Malamut. And a reminder, for all of your financial planning needs, turn to Chuck, who leads his group, the Malamut Group, at Morgan Stanley's Northfield office. I was teasing with a good friend, Mike. It was all in fun. He's a great guy, a great partner with Chuck, and he's got a wonderful team over in Northfield. Chuck does, and Mike is a big part of it. 609-383-2010 is the phone number. Put that in your Rolodex, 609-383-2010, and you too will learn how Chuck has perfected over many decades. Great experience, great breadth of knowledge and wealth in the financial services industry, how Chuck has perfected his concept of total asset management and the all-important asset allocation. This portion of our program also brought to us by MyPillow. Inventor, manufacturer, CEO, owner Mike Lindell, in a Hurley in the Morning exclusive yesterday, took time out of his day. He's all over the place. He was actually in the home of QVC and waking up the morning after his sellout appearance. MyPillow is a game changer if you are dealing with any type of back pain, neck pain, if you're tossing and turning, using multiple pillows, throwing them off one by one, trying to get in a comfortable position, using your arm to help put you in alignment. The MyPillow will do that naturally. All you have to do is select whether you want the firm or you want the medium type fill firmness, which we have one of each at our home, and I ordered a bunch more. The product is amazing. And for Hurley in the Morning listeners, a deal that Mike has never done before. If you buy one, you will get a total of 4 MyPillows. He's never done that before. He's done buy one, you get 2. Buy one, you get 4. But here's how you have to do it, or you will not get the deal. It's very important. I coached a listener yesterday who was on the website but did not click on the radio listener special box. It's right there, center cut in the middle of the website. It will say radio listener special. You have to click on that, and you have to use the promo code Hurley, because without the promo code Hurley, the deal will be about 4 times more expensive, 3 to 4 times more. You can also call if you don't use a computer or you'd prefer to speak to someone, 800-951-8148. Use the promo code Hurley to get the discount, and you tell them you want the radio listener special from Hurley in the Morning. The one, buy one, and you get a total of 4 pillows. 800-951-8148, promo code Hurley. Write it down or go to mypillow.com. And again, use the promo code Hurley. Don't lose another night of good sleep. Back with Chuck in 90 seconds. Don't go away. It's Hurley in the Morning on WPG Talk Radio 1450, South Jersey's talk station.
This is Harry Hurley for All Season Solar, our official and exclusive solar energy provider to the Hurley in the Morning program. They design and they install the most attractive, efficient, state-of-the-art solar photovoltaic systems from the world's leading manufacturers. What I love about dealing with All Season Solar, they're your single point of contact. They do the system design, engineering, your building permits, installation, and the ultimate glorious utility connection day. They take care of everything under the sun so that you can sit back and reap the savings. Call Frank Neal today, 609-317-5491. That's Frank Neal, All Season Solar, 609-317-5491. There's never been a better time to go solar. The benefits are there. New Jersey leads the East Coast and second largest in the entire United States in terms of solar energy panel installation. No deposits, no hidden fees, no out-of-pocket costs. All Season Solar. Tell them Hurley in the Morning sent you.
WPG Talk Radio 1450 is your dependable source for news and weather information here in South Jersey. Listen for the latest national news from Fox News Radio and the Fox Business Network. And now, listen for the latest South Jersey news and your local AccuWeather forecast every 30 minutes all day long. It's the best in talk and local news you need every 30 minutes from WPG Talk Radio 1450 and WPG1450.com.
Cumberland Green Apartment Homes. It's where you live. And now it could be where you live for the holidays. Move in before the holidays are over and get $500 holiday cash. Or you can take it off your first month's rent with Cumberland Green Apartment Homes. Don't wait. Call 856-825-4050 and start the new year off right in a beautiful apartment at Cumberland Green, just off of Route 55 on Ladow Avenue in Millville. For holiday cash details, call 856-425-4050. That's 856-425-4050.
Welcome back. We're here with Chuck Malamut, I know my official financial advisor to the Hurley in the Morning program. You can reach Chuck and his team, the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010, 609-383-2010. Chuck, are we done with GDP revisions, or are we on that?
No, Harry, actually, last week, third quarter GDP was, much to your chagrin, was revised higher, as everyone had expected.
Well, no, don't listen. I want us to do well.
I think no, I know that, but I think the interpretation of the information. We'll leave it at that.
The interpretation is it's crooked.
But
how much did they raise it?
Well, here's the deal. Here's very slightly. I mean, we're looking now growth for the first quarter to be about 2.5%. But here's what happened: gains came from a slower pace of inventory liquidation. More recent data that came across confirms that while it's somewhat generally solid, that being GDP as we know it, it's still mixed as far as the economy is concerned. Durable goods orders were ahead of expectations. Well, the concern is the consumers remain very, very cautious despite recent wage gains. So that's obviously a concern that all of us have. Consumer confidence slipped. Consumer spending's not accelerating. And one of the leading indicators, the Chicago Fed, as we refer to it, their National Activity Index, remains almost close to zero, suggesting that, again, that growth for 2016 first quarter should be about 2.5%. So when you talk about the Fed making their first move and you look at where we are with the economy, we don't seem to think that we're going to have, I guess at best case, Harry, in 2016, a modest rise in long-term yields. Several factors, unrelated economic growth, should keep rates from rising above the 3% threshold. One, we have an aging population that we all, are part of. We have an endless supply of bonds coming to the market and a lot of institutional demand for fixed income instruments. So when you take, Harry, a look at all those and you combine them, we seem to think that yields with the supply and demand out there, increased demand, reduced supply, supporting prices, I think yields are going to probably be low. So the concern that investors have, so we're going to wait, for the Fed to make their first move. I mean, if you get a 25 basis point movement on short-term Fed fund money, I mean, you have a somewhat of a pickup with interest rates to savers, but it's not going to be significant. It's not going to be significant detriment to the economy as we know it.
You know what I think is going to be a lot of fun, because for the most part, is I think we agree and we have covered during your program today, Chuck. 2015 is basically finished. And I mean, there's unknowns that could happen, so I don't want to just mail it in, but it's basically over. I am very curious about 2016 because it sort of enters my world. I really enjoy following financial matters during a presidential election year. Everything is heightened. Everything is more sensitive. It is. You have all these different people that are giving their plans for financial, solvency of America. And you get all this static noise, and some of it's credible, and some of it is sensational, and some of it is highly political to just try to get votes and things like that. But usually, not always, but I've actually done a little homework on this topic, Chuck, not just during my 25 years in radio, but even going back before that. Typically, the year of a presidential election, so we're not counting 2017, January 20th, when the new president would take office at 12 noon, but the whole run-up to that person taking office, which is the whole year of 2016 through first Tuesday, November, it usually bodes well for our markets.
It does, Harry, but I'm going to – your initial comment with respect to 2016 or 15 being over, I'm going to take a step back because – I don't think that's necessarily the case. I think that investors still have a lot of work to do, and I think the market, is going to look at that upcoming, Fed fund meeting, and really, we don't know how the market's going to react. Is it going to be a yawner? Everybody expects it. No big deal. Or is it going to move the market in one direction or another? And I think the most important part of that meeting is, and again, we're all coming to the conclusion they're going to make the move.
Although we've been there before.
Yeah, but
I do feel it, but I've said that before too. But it does seem like this is the one.
It's really the statement. So let's assume they do make the move. I think investors in the market will be extremely focused on the press conference and the statement that Yellen makes after. They come out.
But if the markets want this, and if the markets have baked it in, how come I just have the suspicion that when it happens, it's going to go down that day?
Harry, I'm not going to go there because typically, if once you think that you understand what's happening,
something else happens.
Then somebody's going to hit you over the side of the head and say, you're not as smart as you think you are. So I'm not going to go ahead and say
that's still my prediction.
Well, okay, we can go ahead and put that in the books, but I think that making the move is one thing. I think the language again is very, very important, and I think the other thing we have
wouldn't the language, in order to do it, the language has to be very bullish. It has to be the job market is showing signs of stability and actual growth. We're expecting – here's another one, Chuck. All right, I'll go with you that it's not over yet. We're expecting 190,000 jobs for the month of November. That still has to report.
Yeah, I mean, and if something falls off the cliff with respect to
is that this Friday?
A data point, it'll be Friday. Yes, it's Friday. If
9 o'clock.
If it doesn't come, and then there's a couple other reports that are due, there's no guarantee, and I think the market's going to take its cue moving forward as to what the statement is made as far as what does the Fed view will happen in 2016. Are we going to have that, if you remember the Alan Greenspan days when every meeting, for a number of years, there was a move up 25 basis points.
I personally believe 2016, we've got to get a final break in, Chuck, then we'll have another power segment with Chuck straight ahead. I think 2016 has the potential to be a very good year. It's not a political statement. It's every single time you are in the second term of a two-term president in the final year, there's a fatigue factor of people that grow tired of what's there and want the optimism of a new broom sweeping clean. I think 2016 has the potential to be an excellent year, and that's why when I chronicled about 10 past every 4 years, 10 past election years, there's a very consistent sort of pattern that typically evolves or occurs, with the exception of if you are in the midst of an extraordinary circumstance of war or something that could affect that and stimulate it one way or the other. 35 minutes past the hour, we continue with Chuck Malamut, your official financial advisor here on Hurley in the Morning in our 25th year together. To reach Chuck and his team, the Malamut Group at Morgan Stanley's Northfield office, 609-383-2010. We'll be back in just a few minutes.
A wave of new casino closings could be coming to Atlantic City. Wall Street rating firm Moody's says with 8 new casinos opening in the Northeast in the next 3 years, more AC casinos will go belly up. The Taj Mahal, Caesars, Bally's already in bankruptcy. Governor Christie again addressing Donald Trump's assertion Muslims in New Jersey celebrated the 9/11 attacks after Trump delivered a rare criticism of Christie on the campaign trail.
There's no film or video of it to prove it. He says he saw it on TV. It didn't happen.
Christie's camp is pushing out that soundbite and others from an interview on CNN Monday. The legal dispute between Jenkinsons and the state over protective dunes is making progress. A federal court hearing has been postponed to allow talks to continue. Jenks claims the dunes would make their private beach public. The state is willing to make concessions. Just what concessions will be made, though, not known yet. Get breaking news, weather, and traffic alerts direct to your cell phone. Start by texting news to 89,000. This is the Town Square News Network.
Hello, my name is Rich Tolson. Do you know millions of dollars of construction wages in New Jersey are going untaxed every day? Unscrupulous construction employers throughout the state are robbing New Jersey of much-needed tax dollars by creating an underground economy that adversely affects all of us. If you want to help put a stop to construction wages going untaxed and level the playing field in New Jersey, please call 609-324-1560 or visit us at www.bacnj.com and click on Level the Playing Field. Thank you.
Listen to WPG Talk Radio 1450 with Radio Pup, our free app that puts all your favorite talk shows right at your fingertips. Powered by Autolenders.com. Stay connected with the latest South Jersey news and weather information right from your iPhone or Droid. Radio Pup, powered by Autolenders.com. There's never been a better time to check out all of the low-mileage, one-owner certified cars at Autolenders. See their full selection at Autolenders.com or any of their 6 New Jersey locations.
Have you heard? Proactive Plus is faster and better than ever. Stay tuned for a $1 million bottle giveaway, and you'll also receive free shipping. With Proactive Plus, your acne can heal, and you can help prevent new breakouts. Don't miss this limited time offer. We're going to let 1 million people try Proactive Plus risk-free and get 2 free gifts, and also receive free shipping when you call right now. Call 800-393-6272. That's 800-393-6272.
Welcome back, Chuck Malamut. Yours truly, Hurley in the Morning. Chuck, are we on the global economy?
Yeah, Harry, and if you take a look, for instance, at what is happening with central banks throughout the world, we are at the precipice of actually looking to increase rates. And in the first time, and it seems like for a long time.
It's almost 10 years.
We're seeing that the European central banks are, continue to ease monetary policy in an effort to stimulate inflation expectations across their economy. And then what we're seeing again right now is that the Fed is looking to raise interest rates. So you have the impact of one part of the world reducing rates and one part of the world increasing rates. We're not quite certain what the impact's going to be. But we do know that if you raise short-term rates in the U.S. and lower rates in Europe, in theory, it should mean that the dollar appreciates. However,
the dollar is strong, isn't it?
Yeah, but however, if you take a look at the pricing of those respective parts of the economy and rates, it might already sort of be baked in. The problem, one of the problems that we have with respect to an increasing dollar, I mean, while it's great, for travelers, and it's great, to when you're importing goods, the problem is that with a lot of the companies that are out there, the multinationals that are referred to, the strength of the dollar is actually negative for most U.S. corporate profits. And again, that headwind, as we know, it could very well persist into 2016. So
doesn't that sound counterintuitive to most people that don't understand how it all works? When we hear about a weak dollar, we think that's bad. Now we're hearing that a strong dollar in certain elements is not a positive.
Well, if you take a look at the multinationals, what happens is, because a lot of their revenue or their profitability is dependent upon revenue outside the U.S., and if it's more expensive overseas, to do business and bring those dollars back to the U.S., it's ultimately could be detrimental to the U.S. I think the big thing that we have to be fearful of, Harry, and we don't think it's going to happen here, is that if you remember, we had just extreme upward movement of the dollar over the last 18 months. We're the opinion that that's you might have some upward movements, but you're not going to have it to the degree that we have. The degree that we saw it over the last 18 months. So I think that's obviously good for, profitability, U.S., multinationals, and obviously good for our economy. So, it's anybody's guess, but if you want the dollar to move higher like it did over the last year, then you're not going to be happy owning a lot of U.S. large cap multinational companies. That's for sure.
With basically 30 days left before the new year, when you take today out, I guess count today as 31 days, not all our business days, but 31 calendar days. What are your thoughts? I know that you talked a little bit in the beginning of your program about people making certain decisions before the end of the year, because if they don't know how they can appropriately do certain things, they could wind up costing themselves.
Yeah, Harry, this is again. I don't want to call the year a throwaway year, but it was certainly a year of lack of growth within the economy and within the equity markets. And typically, when you have years like we've had in 2015, and all of us projected this not to happen.
But in fairness, nobody could have projected. You talk about the term geopolitical threats all the time, geopolitical issues. I think you could actually, if we were going to have like a little debate society on this, I'd like to be on the side that actually marvels at the resilience of our financial markets in a very tumultuous year.
Oh, Harry, I don't disagree with you, but
the end result isn't what you want.
The reality is that a lot of strategists and analysts were thinking that the S&P would be higher than it is right now. The concern that we have, and what I mentioned to you before, was the fact that when you look at your price earnings ratios that are affiliated with the respective pieces of the market or companies that are followed as part of the S&P, the higher the PE, the higher the probability is that you're going to have more volatility. So if you take a look, we talked about earlier this morning about what happened with third quarter, what happened with profitability, what happened with GDP. What's going to probably happen, Harry, is that, as we know it, the S&P or the price earnings ratio of S&P 500 companies right now is about 19 times trailing earnings. And that's, when you look at it historically speaking, it's in the top decile of a 10-year valuation range. And typically, the higher you push that PE number, the higher the probability is that you're going to have in the marketplace a fair amount of volatility. And the thing you have to consider is that it's going to be challenging to push profitability and push the equity market significantly higher. So we have to work through that. And in spite of everything that's happening, when you take a look at this, if you polled your listeners, what happened with the equity markets in 2015, they're going to say it was awful.
Yeah.
The market went down. I lost a lot of money.
It feels that way.
But in reality, that did not happen. So stocks over the past couple of weeks now,
basically flat, right?
It is. Well, the S&P's up about 3.5. But when you think about it, the highs that we put in back in May, we're only within a few percentage points of those all-time highs, thanks to that multiple expansion, as I mentioned to you before. Investors willing to pay more per dollar for earnings. So at that 19 times, the S&P is trading at a very, very high level. So we have to be concerned about that, moving forward into 2016. You said, well, okay, we're ending the year. What do we do? I know I've said it, and I sound very, very repetitive, but I will say it again and again and again. This year, a lot of the mutual funds, domestic, large cap in particular, are paying out some pretty substantial gains. And you really need to spend some time to understand what the tax implications are going to be. And you still have time, to do some tax harvesting to hopefully reduce or eliminate those gains. And I'm going to, Harry, I know that I've said it for the last 4 weeks. Mm-hmm. And I'm hoping that your listeners have taken the time to talk, either look themselves if they do not have an advisor, or if they have an advisor, to talk to their advisor.
Because invariably, Chuck, and you probably run into it, and other people run into it, they find out something when it's too late. After it's in the new year, then it's too late.
December 31 is it. You have time. I'm sure every portfolio is not chock full of winners. There's probably one or two positions in there that are underwater, and it might be time to comb through those, because unless you just enjoy paying more taxes, you might want to get in front of it to figure out a way that you don't have to pay the taxes. Very
good, effective closing segment, Chuck. We'll look forward to next week. Anything you want to say in closing?
No, Harry, I think we're it. Thanks for having me, and looking forward to the Fed meeting. We'll see where we go.
It's going to be exciting. Thank you, Chuck. Chuck Malamut, this is his program that we are very, very proud to present each Tuesday morning in the 8 o'clock hour, presented by Chuck Malamut, a financial advisor at Morgan Stanley. The information, views, and opinions expressed on this program are those of Chuck, do not necessarily reflect those of Morgan Stanley or its affiliates. They are current as of the date of this broadcast and are subject to change without notice. Neither the information provided nor any opinion expressed herein constitutes a solicitation for the purchase or sale of any security. This presentation is for informational purposes only. Morgan Stanley Smith Barney, member SIPC. Let me tell you what's going to be happening next. We're going to take a break for about 2 minutes. I think they're going to be running on or right about on time. We have Richard Shadiak, we have Jamie Stein, and we have a patient by the name of Tunighty. And that's the only name that we're going to share. Obviously, it's a patient. We're not giving more than one name. But we're going to be talking about gift giving and what is happening at St. Jude Child Research Hospital, and we have a great topic for you coming up in just a little bit. And then I promise you, I can't tell you how interested I am in Willis Morgan's work, his book, Frustrated Witness, the story of the Adam Walsh case and police misconduct. I have followed that, just horrible. You don't even want to let your mind go to what John Walsh has had to deal with. Imagine losing your son, and he did everything he could, to try to find out who did it. And this guy, Willis Morgan, has written a book. He believes that the cannibal, Jeffrey Dahmer, is responsible. Other people believe it is somebody by the name of Otis Toole, who died in jail a couple of years ago, who admitted to kidnapping and killing Adam Walsh, but then he recanted. And I think he did that several different times back and forth. So that's unreliable. John Walsh believes that it was Otis Toole. I think law enforcement believes that it's Otis Toole. They've closed the case, but Willis Morgan has a completely different investigation about it, and we'll talk about that coming up in a little bit.